small caps will be the real tell as to whether it's a recession to come or not, as to whether it's a credit event or not, because that's the area which is most sensitive to the domestic consumer, the U.S. economy, and to default risk.
Michael Guyette returns. He is the portfolio manager at Tidal Financial Group, and we'll be talking about all asset classes, risks facing the global economy, and the coming credit event. First, a word from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. On this morning, we are welcomed by somebody who has achieved not just his financial goals, but also his fitness goals. You look great, Michael. Thanks for being here.
I've been fasting in preparation for this long-awaited credit event, which tells you I'm probably going to look like I'm super skinny soon.
Are you just on that note? Are you what is your fitness goal here? Like, are you trying to gain a certain muscle mass? Are you trying to lose weight, or like
a little bit. I think it's just about longevity. I'm at the stage in my life where I can't control the value of my portfolio, just like nobody can control the value of their portfolio, but you can control your health, right? So it's been a lot of fasting and focusing on health as much as I can.
That's good. Credit event that we're all waiting for. You've been talking about this credit event for quite some time on my show. Why hasn't it happened just yet?
Well, first of all, I think, the word yet is the key part of that. Look, at the start of last year, I was arguing melt up for 2023, but towards the end of the year, there was a risk of a credit event on the lagged effects of the fastest rate hike cycle in history. You obviously didn't have it. You ended up having one of the biggest rallies in history on a very short-term time period, at least for large caps. But I will tell you, it's interesting. A lot of people say, well, you were wrong on the thesis, but we're still in that lagged window. And if you were to look at small caps, which I say repeatedly on X and other platforms are the key to the whole thing, you got to ask yourself, why is it the last 10 months small caps have largely gone nowhere? And it has to be because small cap investors are worried about a credit event too, because they're highly levered. They got to roll over their debt into higher rates. And by the way, every day that goes by, you're closer to this debt tsunami refinancing wave taking place starting this year into next year. So why didn't it happen late last year? Because it didn't happen. Doesn't mean it still can't happen at some point this year. There's going to be a point where the lag is going to be too long, in which case you've missed the moment.
Okay, let's recap.
The risks are there.
Let's recap for the audience, because it's been a couple months since we talked about this on my show. What exactly is this credit event we're talking about? What is this?
Very, very simplistically, a credit event is no different than saying a VIX spike, because the volatility of equities is correlated to the differential between junk debt and AAA, meaning the repricing of default risk perception in the bond market. Now, by the way, entering November, credit spreads were starting to widen, which is why I thought that may have been it. It may have been, this was the moment where it could happen. Instead, by the way, the Fed basically caused the market to think that they'd cut 6 times. You had one of the greatest periods of financial easing you could imagine, November, December, which caused this rip higher in equities. But then I go back to my original thesis. Why is it that the Fed suddenly got spooked? Maybe they were trying to front run something happening, or at least stresses started to come up. Now, look, whether an event happens or not, I always go back to path matters more than prediction. You can have equity markets obviously rally. You can have a catch-up trade in small caps, but the risk is still there because, as you're seeing with these community banks, these things take time to play out.
Yes. Why the VIX in particular? Why not the MOVE index, the MOVE, the VIX equivalent for bonds?
Yeah, no. So, and this relates to the flight to safety trade, which has been lacking, and relates to treasuries as the sort of risk-off play. If you were to overlay credit spreads against the VIX, you'll see a one-for-one relationship. What happens historically is that when volatility rises, volatility is not really fear, right? Volatility is doubt. So if you have doubt in equity markets about the likelihood of the future being better than it was, then you're going to have doubt among lenders of capital to highly indebted issuers around their ability to pay back what you're lending them. That's why default risk gets repriced, and that's what causes junk debt to really get hit. That's still coming, I think.
Well, we've got 20 minutes left, and it's your first time on the show in the new year in 2024. So let's go through all asset classes as much as we can, and then highlight your overall thesis once more for the audience. So let's start with monetary policy first. I think everyone's wanting to know what Fed cuts are going to do to markets this year. First of all, so do you think that 6 or 7 cuts, which is what the equity markets have been pricing in December, is fair?
I honestly, so look, I'm of the opinion they probably have over tightened. And I think small caps agree with me because that's the only explanation, again, for why they've gone nowhere for the last 10 months. Now, having said that, I don't see how they can lower rates unless they really did pull off the soft landing when credit spreads are still this tight, which, again, has been the missing ingredient in all this. The Fed doesn't respond to equities. They don't respond to even treasury yields. They respond to default risk, which, again, it goes back to credit spreads widening. So I don't recall there ever being a time where the Fed has pivoted on lower rates with the bond market stress itself not being there, right? And that's why I think the Powell has walked back the timing, right? Now, it does become tricky, though, because I go back to what I said. You've got all of this debt that's going to be refinanced starting this year. So the Fed has to get ahead of that, okay? And small caps are, I think, very sensitive to that point. But they can't get ahead of it too early because spreads are so tight. They can't get ahead of it. They can't, if they don't get ahead of it, then you might have some mass bankruptcies in the small cap, small business space. So I think this is a really, this is like more than threading a needle, right? It's even a smaller window in terms of the time frame, especially when you consider that there's lags to them lowering rates too. So I think they probably will lower rates, but I think you need to have something start to break first.
Wait, sorry. Why does something have to break for them to lower rates? I mean, they've kind of just telegraphed it, and it's just a natural course of events. If they don't lower rates at some point, they will cause this breakage if they don't, right?
Right. Well, I think they're hoping that it's a bend, not a break. But to do it here would really reignite potential inflation.
Okay.
Because then you're going to crush default risk even more, right? And you'll get to a point where junk debt yields as much as treasuries of the same duration, which would make no sense.
So, I think it's the natural course of events is no cuts. Is what you're saying. So something needs to force the Fed to cut rates. Is that the right summary here?
I think so, and I think that's going to come because I got to go back to I think that event is out there. If small caps keep meandering and they don't really push to new highs, that's a real problem, right? Now, against that backdrop, you have this argument that's out there that it's an election year and the Biden administration will do whatever it can to keep markets up. And I put that post out that went a little bit viral just the other night. It's like we forgot that the year 2000 was an election year. You had a tech bubble then. We forgot that 2008 was an election year. You had a financial crisis then. We also forgot that 2020 was an election year. You had COVID then, right? And there are some interesting parallels to 2000, 2008. You've got clear AI mania. You've got a concentration bubble in tech, some select large cap tech stocks. And I'd argue what still looks like a bear market for everything else. Look at micro caps. The riskiest part of the stock market have not acted like it's a bull market whatsoever. That's what makes this whole environment so weird. And then you clearly have a ongoing crisis in some of these regional banks, which has taken a year to really play out with some of these still going under, as we're seeing. So my point is like this year could still be very nasty and tricky and full of surprises.
Okay, so I've got to ask, Newton's first law, the law of inertia, everything keeps going straight in a straight line until some external force pushes it to either change course or slow down or accelerate. So what is this external force that's going to change the Fed's course of action? Is it a credit event? Is it something else?
Yeah, I think historically that's the thing to watch out for. I mean, the Fed is always the entity to save and always the entity to break, right? I mean, that's how monetary policy seems to work historically. And you don't have to talk about this before, but I still think the risk is this reverse carry trade with Japan as a catalyst. But look, China is in bad shape, right? I mean, there's a lot of things which are still happening beneath the surface that and globally that would suggest you actually have some real deflationary pressure coming outside the U.S. against countries that have huge debt in the Eurozone, in China. So I always try to frame things in terms of conditions. I don't know the mile marker that something might happen in. I don't know what pellet of rain causes the swerving of the car. I just know that you still got to be careful and try to slow down. Again, that doesn't mean you can't play the long side. That doesn't mean you can't be in equities. But you got to also be careful as far as how much overconfidence you have around this bull market narrative, which again is very selective.
Well, speaking of equities, the S&P 500 just today, this morning on Friday, reached 5,000 points briefly. Now this happened before earlier last week, but it's quite an achievement. Michael, where is this headed? Is his momentum going to continue, you think?
I've used that line before, and I've been obviously very early and wrong in pointing out the mania around NVIDIA, but I think it should be very clear we're in a mania for some of these AI names now, right? The things that people attacked me for saying months ago, they are now starting to say themselves. And I'd rather be early than late, because if I'm early, I can at least manage risk on a go-forward basis. Early and wrong are not necessarily the same thing, depending upon your time frame. But I think it's possible that you could have small caps play catch up. Yes, it is possible that the Fed pulled it off. It is possible that you don't have a credit event, in which case, yeah, the way to play it should be on the broadening out of all the companies which have lagged this AI rally, on the idea that they will actually benefit from all the productivity enhancement and margin gain and expansion that comes from the output of this technology. But the question is AI more powerful than interest rates? That remains to be seen.
I'm just going to push back on the mania comment. So, at what point does something stop becoming a mania and is just a bull rally? Because this thing has been in a mania for more than a year now, right?
So I've used this line a few times. When a rising tide does not lift all boats, everybody drowns.
Okay.
So a mania, which is resulting in and this is just facts. It is a concentration bubble. You've never had, the top stocks in the S&P 500 be this much of a large portion of the S&P 500. So
Right.
you're getting this narrower and narrower type of movement. You went from Mag 7 to whatever, now 6, now 5, now 4. It's getting to the point where it's like if you just remove NVIDIA and Microsoft, the S&P is probably not at the 2021 highs, right? Given the level that we're at now. So my point is that it becomes a bull run when beta, the bull, right, in the B in bull is beta, meaning everything participates with beta. It's not just a couple of stocks.
Yeah, well, you're right that the Russell 2000 is up only 1.7% on a 12-month basis. So if you strip
Right, which goes back to my point. It's like how people have to step back and think to themselves, maybe I'm not that far off in my original thinking. The way it's playing out is not the way I thought it could play out. But how else do you explain small caps going nowhere? And you can't say that small caps don't matter because everyone's indexed to the S&P and to large caps. Small caps are small businesses. You want to see a spike in unemployment? Take out half the Russell 2000, make them all go bankrupt. You'll see a Great Depression.
Your lumber to gold ratio has been quite accurate in the past in predicting volatility. How does it work? Where are we at right now?
Yeah, and actually, and it's interesting even looking at utilities with lumber to gold. So it's been a risk on. I mean, my own funds have been exposed to the rally equity wise, even though my tone has still been negative because I'm still nervous about the conditions under which I'm speeding up in, right? Which seemingly nobody else is even thinking about. But lumber to gold looks like it's about to turn negatively, which should be risk off, I think, probably in March. Utilities are actually, I think, more interesting. So typically, utilities relative to the market and lumber relative to gold are both leading indicators of volatility. When you have high volatility, utilities are also strong and outperforming. Now, start of the year, first week of the year, utilities were among the best performing sectors, and then completely they've crashed relative to equities. Utilities they're down, they're not participating. It's like a horrible performance. You're getting to the point now, which by the way is consistent with risk on, okay, very short term, and that you can argue has been right. The problem is now you're getting to the point where the complete underperformance of utilities is very reminiscent of March of 2000, which was the blow off top for the tech bubble. So you combine utilities maybe going through a capitulatory bottom process, which I think is starting. That's a risk off defensive signal to come, combined with lumber to gold starting a week. Yeah, that probably means around March you have a risk off setup. That doesn't mean that's a credit event. Maybe it will be, right? It's interesting that coincides with the possibility that the Bank of Japan would actually do something on their own monetary policy side, which sparks the whole reverse carry trade. But either way, the path is what matters. And I think the defensive behavior tells you something is coming and we might be in the final stages of this blow off.
You know, what I've noticed that's very interesting is that if you overlay the utilities ETF XLU, well, one of them, XLU I'm using. And if you overlay that with gold or the GDX or the GDXJ, which is a junior minor gold fund, like a port for correlation over the last 12 months. Is that normal? Like the utilities usually follow gold. I don't think it usually does, but I think in this particular case in the last 12 months, it did. That's very interesting to me.
Yeah, no, well, and it goes back to, I think we've talked about this a couple times, but again, you can be bearish and long, and the way to be bearish on stocks and long is treasuries, which again, that's been my problem in my own funds, but I think it's about to change for ATX, for and Jojo. The dollar, which has been a clear risk off trade, but then also gold and utilities. So the risk off beneficiaries of volatility in equities do tend to correlate. So it does make sense that utilities and gold would act the same because they tend to be more defensive plays when it matters.
Okay. Are you expecting then utilities and gold this year to start outperforming if we're seeing this credit event unfold?
I said it at the start of the year, and obviously I've been very wrong to start, but it's only been 5 weeks into the year. I think utilities may be one of the best performing sectors, if not the best performing sector for the year. And I think gold itself also probably does pretty well. Again, just because I'm expecting more volatility regardless. And if I'm right that we're in a tech mania, and if I'm right that we're maybe towards the final stages of it, unless small caps really start to run, then there's going to be a rotation into defensiveness anyway. And that includes consumer staples and healthcare. But I think utilities, because they've been so bombed out, like treasuries, they probably work better.
Okay, interesting. And let's talk about the yield curve, the 10-year minus the 2-year. It's been uninverting for quite some time now. What's this signal of right now? What is this signaling?
It's signaling that everyone should be looking at it and getting wrong about what's happening next, because it's supposed to be about a recession, right? And that's not really taking place yet. Again, you need probably to have a credit event for a recession to take place. Default.
So actually, Michael, I'll let you finish. But in the past, whenever the yield curve uninverts, that's when we get a recession. It's when we have an inversion and then it goes back up to zero. That's when a recession hits. It's actually been pretty foolproof. But yes, please continue.
Yeah, I know, but yes, it has been pretty foolproof. But which again, maybe that's again what also small caps are sensing, and retailer stocks should have gone sideways, right, against a supposedly strong consumer and healthy employment situation. Look, I think there's a very good chance that we're going to have a recession, in my view. Okay, but there are always false signals. So even though it has a good track record, maybe again it's not. That's why I'm saying I really do believe this. Small caps will be the real tell as to whether it's a recession to come or not, as to whether it's a credit event or not, because that's the area which is most sensitive to the domestic consumer, the U.S. economy, and to default risk.
Okay, so my question is, will this steepening of the yield curve continue, meaning the long end of the curve rising faster than the 2-year? Certainly, if we get Fed cuts, the 2-year will go down, if not stay flat. But what about the 10-year is my question.
Well, so you're hitting on something which is like another one of my pet peeves around this AI narrative, which is only being applied to a select number of stocks. Okay, so if AI is disinflationary long term, and if it's going to accelerate, right? If there's a period here going forward where AI is going to really just be in every single part of our lives, that should be disinflationary, which means long yield should be dropping. That hasn't happened, right? So that's what I'm saying. Even the inversion on inversion gets complicated if the AI narrative is a real one to focus on from a longer term disinflation perspective.
Okay, is it possible that the long end of the curve is projecting some sort of economic growth or recovery? Is that what's happening?
No, yeah, well, but the yields have been kind of. I think if you look at TLT, it's really on sideways since December. But look, again, I think there's so much noise going on in the bond market and disagreement. Again, going back to credit spreads and the yield curve, right? That one of them is going to be right. Small caps and credit spreads as well is another disagreement. So it's hard to know if there's any real signaling there just yet.
Let's finish off on the Bank of Japan. You've talked about this before with me. Is Godzilla still coming from the Bank of Japan? I think their rates are still negative, but they're talking about raising them.
Yeah, and I can go back to watch the yen, right? Because if the yen does keep on doing what it's doing and weakening, that's inflationary pressure. They have kept on floating this out there that they're going to normalize in some way monetary policy. And again, I go back to who the hell knows what normalization means for Japan, right? Because given their debt loads and everything they've gone through the country for the last several decades. But my point is, nobody really knows what the effect of the Bank of Japan's actions will be, nor does the BOJ. So we are getting closer to that moment where they're likely to do a change. Now, it could be something, it could be nothing. But all I know is that, as I keep saying, if there is going to be a catalyst that sparks volatility in equities and then credit spreads widening, that domino effect, I think it has to be from a part of the world that is hard for people to understand the effects of from a secondary and tertiary perspective. Everyone keeps looking at the regional banks and saying, how can it be that these regional banks in the US are collapsing like this and nobody cares? Because it's almost too obvious. It has to be something that's not obvious that is the spark. It has to be a surprise in terms of the effect. And I still think Japan is that surprise. Again, I've been saying that admittedly for like 5 months now as a possibility. 5 months, maybe I'm wrong, but if it happens in a few months from now, I don't know if you can say that I was wrong because I was early in the context of markets, which are years, of data.
Would you be long the yen versus the dollar right now?
I think it gets to be interesting to do that. Yes, I think that makes some sense. And the yen historically does act like a risk-off trade. I would rather, I think, hold treasuries because I think that everyone has assumed that treasuries are broken because they're missing the transmission mechanism. Risk-off treasuries are not a hedge to stocks; they're a hedge to volatility, which is what we haven't really had. I think that I'd rather hold it. But again, it's like if you're going to if you're going to be risk-off, you do a basket of risk-off: gold, utilities, dollar, yen, yen against everything else, not against the dollar. I think that makes some sense. Yeah.
Yeah. Okay. Well, let's finish off on your work. Let's talk about your funds and also your lead lag report. Some of the recent research you've been doing on the lead lag report.
Yeah, no, I appreciate that. So, aside from the risk signals, which again have largely gotten this right in terms of the path behavior, despite my tone being negative, it's all available at leadlagreport.substack.com. Separate effort from my rules-based funds, which would run the same way if I died tomorrow. I think the cycle. Look, my punch in life is my funds, and they've had a hard time. They've had a hard time because they're supposed to be in treasuries when risk off. And if you haven't noticed the last several years, that's been the worst bear market for treasuries in history. I have gone through hell in that approach. But there are cycles, and the go forward return for my own strategy should be better just because of what's happened to treasuries, right? So my Roto ETF had a really good year last year, despite there not being risk off. I think if there's one of those moments where you get that convex outperformance in treasuries against equities, a lot of people will be surprised by how these strategies can work, but I need the path. I need the sequence. I need both the risk off and then to go back risk on at lower levels in equities and higher yields at junk debt for my JoJo bond fund.
Okay, perfect. Where can we follow the lead lag report?
At Lead Lag Report on X, Instagram, Threads, YouTube, anywhere that you find annoying people, I will be there.
Follow him as well on YouTube. You have a YouTube channel, so I think fewer annoying people on YouTube than on X these days, but that's just my observation.
Well, I think there are more of a side note, but I'm pretty sure that there are bots that are programmed to be vicious and nasty and try to play mind games with people.
You know what it is that if you're on YouTube, you're already like investing your time to watching something, so you're not gonna just troll somebody for the heck of it. But whereas on Twitter X, there's no time investment. You can be sitting on your toilet and scrolling and just like Michael sucks, and then you're off.
Listen, I have a virtual background. For all you know, I could be sitting on a toilet right now.
All right. Well, we appreciate you joining us, and good luck with your funds. Good luck with your workout routine. We'll see you again very soon. Well, let's catch up next month.
Absolutely.
Thank you, and thank you for watching. Don't forget to follow Michael in the links down below and subscribe.